All right. Thank you, everyone, for coming to this talk. My name is Ben Soltoff. I am an Environmental Innovation Fellow with the Center for Business and Environment at Yale, CBAE, and the Sci Center for Innovative Thinking at Yale. We're very excited to bring Namrita Kapur today to talk about bridging the gap from philanthropy to impact investing. Namrita will tell you a little bit more about her background, but it's spanned a wide variety of investing activities from private sector to large NGOs to philanthropy, and she's going to talk about going back and forth between those different worlds. I borrowed a clicker for you, just to give you some context about kind of why we brought Namrita Kapur here today. There's been a huge swell of activity and interest around the idea of sustainable finance here at Yale. There's Yale Institute for Sustainable Finance here at SOM. There's an impact investing club, the Mint competition, the VEPC club. There's a huge amount of interest here, as well as in other parts of campus. And so this is something that at the Center for Business and Environment, as well as Sci-City, we're going to be focusing on a lot more over the coming year. And Namrita's participation is a big part of that. We've got a couple independent studies, one about financing early stage climate innovation, and one about scaling climate philanthropy, both advised by Namrita. The one about scaling climate philanthropy still has some openings, so if you come out of this talk really excited about the idea of climate philanthropy and how that solution can address environmental problems and climate change, follow up with me or with her. We'll also be having an intensive at Sci-City, which is kind of a co-curricular, multi-session, cohort-based learning experience at Sci-City. Applications for that will open later this month. And we'll be doing a kind of networking exercise of connecting people who have founded companies with people who can fund and support those companies. So if you are an environmental innovator or are looking to plug into those networks of innovation, please consider staying tuned for more information about that. And just before I bring Namrita up to speak, I asked her, just as she was on her way over here, to share a fun fact, and it was very much in line with her background as an investor. She said the first investment that she ever made was a sustainably raised cow in Brazil. And with that, I will leave it to her. Welcome, Namrita.
Thank you. Am I on now? So the mic is working now, right?
Yes.
Okay, great. Well, thank you, Ben, and thank you so much for having me here. And I'm so pleased to see so many people come out for this talk, not only because it's a personal passion of mine, but I really do feel that this issue around bridging philanthropy to impact investing is going to be key for really unlocking what's the hoped-for promise of driving the type of impact that we want from impact investing. Before I jump into the core part of the slides, I wanted to give you just a little bit of a backstory on the slide deck that you're going to be seeing. This came about through an engagement I've done with National Geographic on impact investing. So it was just about a year ago that a friend of mine, a classmate actually from School of Forestry, called me up, Jonathan Bailey. He's now the chief scientist at National Geographic. And he was asking me all about impact investing because he had just completed their 5-year strategic plan. And in it, he had focused in on an impact investing strategy. And this was not from their corpus, sort of their mainstream balance sheet. They actually have a very large balance sheet because, I don't know how many people have followed National Geographic, but they sold off the media side to Fox News of all places. And so they got a huge slug of cash. That's their sort of main corpus. But what was something that I actually didn't know about National Geographic is they actually also have a philanthropy portfolio. They do between $15 to $20 million worth of philanthropy a year. And he oversees that philanthropy portfolio. And so he was really interested in seeing from the philanthropic portfolio, how could they think about catalyzing more impact investing. So he was talking to me about this, getting some advice because he knew about my background. And finally he said, well, is there any way I could get you to do this for me? And so next thing I know, I'm leaving. At the time I was at EDF. I'd been there for almost 9 years. Some of you might have seen the talk that I gave around this time last year, talking all about my work at EDF. and took this leap to help him with this focus. And so he had asked for an impact investing strategy, and I'm going to do the spoiler alert, essentially, or the spoiler on where I ended up. I came back to him and said, you don't want an impact investing strategy, for 3 reasons. One is it's a very crowded space. 2, you really actually don't know that much about impact investing, so it'd be hard for you to compete in that crowded space. And 3, the place where there's a big gap and where you actually have a lot of expertise to bring to bear is essentially on venture philanthropy. How can you mobilize your philanthropic portfolio to help build the pipeline of opportunities in impact investing? And it was just so, it was fascinating to see, here I was a little nervous about basically coming back to my client and telling them what you asked me to do, I didn't do, because essentially. But I found that there was like this big sigh of relief that went through the executive team when I said this, because I think they already sort of realized that that's not where they wanted to be, but didn't really have the evidence. And so the deck I put together for them, which you'll see the front part of it, was essentially giving them the evidence so that they could move forward with this venture philanthropy strategy. So that's a little bit of backdrop to the deck you'll see, and then also just a little bit about my path. Ben's encouraged me to share some more details. Frankly, it is not a very direct path. My purchase of the cow was because I was actually living in Brazil. I was teaching primarily high school biology at an American school in Sao Paulo, Brazil, and had a chance to go to a cattle auction. The next thing I know, I'm bidding on a cow. And then during the time that I was living in Brazil was when the first UN conference on climate change occurred. And that influenced me to come here. And I actually didn't enroll in SOM right away. I was planning on just doing the forestry school, and then next thing I knew, I realized I really needed the skills that SOM would provide. And so I did the joint degree then. After that, I was the director at the Environmental League of Massachusetts. There, one of the things that I focused on was developing their Green Budget Initiative, which is still sort of one of the foremost environmental initiatives in the Massachusetts landscape, and a real differentiating factor for ELM, which interestingly enough is led by another joint degree student, Elizabeth Turnbull Henry. I think she's class of 11, maybe from here. And then after ELM, I do what most environmentalists do, and I went into investment banking. And I was developing and leading their alternative energy franchise at this investment bank. And I got extremely lucky, I consider extremely lucky, as to who my direct supervisors were there. Some of the pioneers of environmental investing, people like Matt Patsky, who's now the CEO of Trillium Asset Management, the oldest socially responsible investing firm in the country, and Jack Robinson, one of the earliest developers of an environmental mutual fund. Then after that, I got lucky again, met another Yale alum, this time undergrad alum, Willie Foote, and became part of the founding team of Root Capital, which is one of the pioneers of the impact investing space. Root Capital, before we became Root Capital, we were called Ecologic Finance, and we were an award winner in what was called the Yale and Goldman Sachs Nonprofit Entrepreneurship Competition. Our business case for our expansion into Africa from Latin America won that award, and then our business plan actually was used as part of the core curriculum here at SOM for a few years. And then after Root Capital, I joined EDF, headed by another prominent Yale alum, Fred Krupp, and also another prominent person at EDF, Nat Cohan, used to be a SOM professor. So as you can see, Yale's been a little bit of a theme in my career. The network's important is sort of the subtext there, right? And then, as you heard the story, my departure from EDF was relatively recent. First with National Geographic, and that continues, and I'm also now primarily working with the Family Foundation of Eileen Rockefeller, and in that role, I'm both working directly with our grant portfolio, which is focused on transforming the electricity sector globally. And also, one of the more interesting parts of that work, and I'm happy to talk about this later, is that we coordinate with 40-plus climate philanthropists globally to mobilize capital together under a sort of single strategy, if you will. So that's a little bit about my path. So let me jump into the content of the talk. I'm going to start with the scale of pools of capital. These are current numbers. And these are largely US numbers, unless where it's indicated. So there's the big dark blue bubble, US total assets, managed assets. Then you've got the sort of brighter blue bubble inside of it, sustainable, responsible, and impact investments. And so this is both sort of screened funds. So that's kind of like the lowest common denominator for ESG, if you will. So it's everything from being like negatively screened, saying, okay, I don't want alcohol, tobacco, fossil fuel-free, as well as sort of those proactive impact investments that have become a little bit more common or known of these days. And that bright blue bubble is the figure that you might hear from time to time, that 1 out of every $5 in the US that are professionally managed have some type of ESG screening on it and growing. So just to understand, when you hear that figure, yes, it's impressive, but it also is kind of the lowest common denominator. It's not sort of what you think of as like, some people might think of as like really robust ESG investing. And then from there, you see the bubbles get small really quickly. So if you look at what are actual impact investing assets, and this is based on Global Impact Investing Network's research, it's pretty small, 114 billion. And then conservation impact investments, which is where I was focusing for National Geographic, much smaller still. You look at philanthropy and how dwarfed that is, even as a whole. But even more importantly, if you're someone like myself who's been focusing in the environmental space and environmental philanthropy, how, like, just one single portfolio, even some of the largest portfolios, like Bloomberg Philanthropies, how there's still just like so many angels dancing on the head of a pin relative to what's happening in the mainstream capital markets. And so in some ways, impact investing kind of came up from noticing this and saying, how can we take that philanthropic bubble and sort of aim it at that big dark blue bubble so that we can really sort of see all investing become sustainable? I mean, in some ways, that's the holy grail, right? If you can get that biggest dark blue bubble working on behalf of all the issues we care about, we actually might have a chance at changing those issues and seeing the success that we want to see. The other thing I want to point out about this is that biggest dark blue bubble, say conservatively, is probably about 30% of that is just as a baseline unsustainable. So if you think of a lot of your conventional energy, heavy industry, chemical companies, those types of things, long term, like we really kind of want them out of that sector completely. And there's sort of two ways to think about how those things get out of there. One is a lot of the things that are happening these days around the divest movement and regulatory reform to sort of change the economics, essentially, of that dark blue bubble. And then two is new solutions that are coming up. And in some ways, that's sort of what's happening with the impact investing world. Is like, how do you create those new solutions that basically sort of compete out some of these unsustainable industries that are part of that big dark blue bubble? And so we're going to talk a little bit more about that as I go into the next section and talk about the spectrum of capital. Let me pause there, though. Anyone have any questions about this before I move on? Good, okay. So here's spectrum of capital. I really like this diagram. This is Bridges Ventures, founded by Sir Ronald Cohen, who's also the sort of founder of social finance and the social impact bond movement. This diagram I like for two reasons. First of all, or actually three reasons. First of all, it sort of really clearly lays out sort of the different pieces of the spectrum of capital, from philanthropy all the way to traditional investing. The other thing I like about this is how clearly it defines impact investing. That term gets thrown around a lot, and frankly, often gets thrown around inaccurately to mean probably sometimes even as much as the things that are happening in philanthropy all the way to responsible investing. The definition is really in those two areas. It tends to be, it's going to be these private companies, and right next to philanthropy, it tends to be more concessionary capital. And then when you move to the thematic place, that's where you tend to see more of the market rates. And then it starts sort of entering into the public markets and moving into the rest of the spectrum that's a little bit more familiar. So that's one of the reasons I like it, is that it so clearly defines what is impact investing. The other reason I like it is because, for me, it sort of is almost like a theory of change for when I think about what I was talking about in the last slide, about how do you create those new solutions that are going to really compete out the unsustainable things that are part of that big dark blue bubble. So, and my sort of hypothesis is that if you have a lot of really clear stage gates that move things from right to left, that eventually traditional is going to be, all you have to do is focus on financial returns, because embedded in those financial returns are the impact that you're looking for. And to me, so that's sort of how I think about my larger theory of change and trying to make this happen. And I'd argue that when you go from sustainable to traditional, that's sort of a pretty well-established space. Like, if you think of Trillium Asset Management, it's been around for more than 40 years now. So that's a pretty well-developed set of spectrum, if you will, and the stage gates from that point on are pretty good and are doing their job. From philanthropy towards sustainable is where it's a much more inchoate sector, and where there needs to be some more thinking. And there's been a lot of focus on this sort of impact first, thematic, and then thematic to sustainable. But that bridge between philanthropy and impact first has kind of gotten a little swamped out. I feel kind of, from someone who actually was, in the impact investing arena directly when I was at Root Capital, it's, the impact investing world kind of sucked the air out of the philanthropy world. All of a sudden, it became much more difficult to have conversations with the donors that we needed to have supporting our model, because they all wanted to become investors. Everyone sort of had this impression that, oh, well, of course, if I can create the impact and get a return, great. Give me that. Why should I give you some? Why should I basically get a negative 100% return, right? Through a grant. Well, it turns out it's really, really important, because without that sort of risk capital, that R&D money, it's really hard to get anything in that impact first model. And you see that in a lot of the spaces that are more recently emerged as asset classes. Microfinance, 30 years of philanthropy went into it before we started seeing those first type of impact deals, and then eventually billion-dollar IPOs. Same thing for the space Root Capital inhabits, that small-scale agricultural finance. It wasn't 30 years. We learned something. We didn't need as many, but make no mistake, it was really important runway to get root capital. And root capital still not, it still can't claim that it's market rate returns. And there's always, if you're really focusing on impact, there's always that sort of R&D and things you don't know that the financing, the mainstream private capital isn't going to pay for. And that's where philanthropy is best positioned, just to underwrite that risk to then unlock the private capital later on. And my example that I gave to National Geographic's executive team was in the conservation finance space. So and these are, I believe, I think these are 2016 numbers. 8.2 billion had already been raised for conservation investments. 3.1 billion remained undeployed. There was capital waiting to be deployed that wasn't being deployed, which is, when you think of it from the scale of all the different issues we're trying to address, that you've got this money that's sitting there waiting to be deployed and not being deployed, gosh, it seems like kind of a tragedy. So let me dig into this number a little bit more. So this gives you a little more sense of this gap. So these are 2014 numbers. So if you look at all the literature, and this is a report by Credit Suisse, WWF, and McKinsey, looking at all the literature around biodiversity conservation. What's the amount of money that you would need relative to what was in place? So you can see that there's a gap about 20 to 30 times the amount of money that's needed. And you can see they've divided up that pale green versus the brown. The pale green is the philanthropy that's needed to fill that gap, and the brown is the private sector capital that's needed to fill that gap. And based on that fact that I just shared about sort of the undeployed capital, you've got a lot more visibility on that dark brown bar than you do on the green. For all intents and purposes, there's a lot more availability of the private capital than there is the philanthropy that's willing to step up. And part of, again, it's that sort of dynamic of the shiny new thing is what I sometimes call it, right? Like, oh yeah, I'm an impact investor. Why would I want to, being a philanthropist, that's so passé. Why would I want to do that? I want to get a return as well as generate impact, which great, yes, but unless we sort of build that runway, we won't have more than one-offs on the impact investing front. And then, so talking a little bit more about what is that gap? So venture philanthropy, so when I looked into the literature, this is how it defines that gap. Having venture philanthropy, an approach to build stronger investee organizations with a societal purpose by providing them with both financial and non-financial support with the goal of increasing their societal impact and allowing them to scale and attract more capital. And so, interestingly enough, Grow Wild Family Fund is a venture philanthropy organization. And venture philanthropy is a term that, frankly, has kind of, I wouldn't say fallen out of favor, but just sort of been eclipsed by impact investing. About 20 years ago was when it was sort of in vogue. And one of the things that I've sort of learned about philanthropy just in this year that I've been in it is there is very much the sort of flavor of the month thing that goes on in philanthropy that people are, I see Neil smiling. And Neil works with Echoing Green Foundation, which is another example of a venture philanthropy organization providing that sort of early risk capital. And so there's all this, so venture philanthropy was the hot new thing about 20 years ago. And now no one talks about it at all because everyone's focused on impact investing. Yet so important, like any sort of, like our mainstream financial system, just imagine how absurd it would be if when the VC world, when that came about, everyone said, oh, VC, oh, that's great. Yeah, let's all do VC, and completely abandoned doing IPOs and publicly, right? Like in our normal for-profit financial sector ecosystem, you need to have a whole array of different types of players and different types of capital playing that early stage to late stage roles. Same thing's true in philanthropy, surprise, surprise. And yet you don't have as many people being willing to sort of first of all, identify with being part of different parts of the ecosystem. But second of all, also staying loyal to that role and sort of recognizing that there's value in them playing in that role. I'll give you another example from my time at Root Capital that I often like telling the story. So Root Capital had, we had both our loan fund and we had our operations, if you will. So our loan fund, we'd raise loan capital. People would charge us interest on that, and we'd use that capital to on-lend to our organizations. We'd make money off of the spread, but not enough to cover our operations because our operations were more expensive because we were going to basically these unbankable regions, and so we had to spend a lot of money in terms of travel and the types of investment officers and so forth to do these types of loans. And then so we would raise money then to cover the balance that we couldn't earn off of the spread. So this was, I think it was like the third year that SoCap was running. And we were announcing at SoCap that Starbucks was going to become an investor in Root Capital. And what was interesting about this investment was it wasn't from their philanthropic arm, it was from their balance sheet. So it was the treasurer that was coming to make the announcement. And I was on a panel with Richard Lauch, the treasurer of Starbucks, Preston Pinkett, who at that time was the head of sustainable investing at Prudential, who was also an investor in Root Capital, and Anthony Buglevine, who at that time was at the Rockefeller Foundation and was leading their impact investing portfolio, and who was also, Rockefeller was also an investor in Root Capital. And so Richard Lauch proudly announces this investment in Root Capital, and then Preston Pinkett looks at him and says, I don't like the fact that we are subsidizing Starbucks. And then Anthony turns to Preston and says, I don't like the fact that we are subsidizing Prudential. And then I look at them and I go, why on earth not? This is a fantastic thing you've all done. Rockefeller, with your investment, you unlocked Prudential. Prudential, with your investment, you've unlocked tenfold Starbucks. And so that's just an example of like the power of like when there's that diversity of capital providers and players, how much you can unlock bigger pools of capital and really drive much more impact. So that's just my other little aside. So then venture philanthropy, a little bit more about venture philanthropy. These are some of the characteristics of venture philanthropy. Interested in a long-term horizon, so that usually means like multi-year funding, which is again kind of like a holy grail in philanthropy. Surprisingly, doesn't happen that often. Having like 2 to 3 year at least time horizons. Flexible forms of grant capital, which basically means you can use it for whatever you need to use it versus it being very project specific. Hands-on, non-financial support. So that's a big part of my role, working directly with the grantees and helping them with their organizational development challenges, because a lot of these they're startups, and just like any type of startup, they kind of need help with some of those basics. And that's only once they sort of become more robust as an organizational structure will they ever be able to think about becoming a private sector type of opportunity that can take on impact capital. Funding innovative high-impact business models is basically risk, like willing to take a chance on something that still looks very risky. Again, hard for the private sector to do that. Philanthropy, it's a great role. So that's why when Rockefeller Foundation, being an early investor in Root Capital, critical and an important signal. It helped us basically write down the risk or de-risk the effort such that then Prudential and then eventually Starbucks could come in. No short-term expectation of financial return, very helpful not to have that type of pressure. And then seed funding. One of my favorite examples from Growald Family Fund that obviously predates me, Sierra Club Beyond Coal campaign. So that started, and I don't know how early this was, it might have been as early as 2007, where Growald provided a $100,000 planning grant. So it wasn't even an initiative at all. So a planning grant to say, hey, let's build the business plan for what this looks like. A few years later, it got $50 million from Bloomberg Philanthropies. And then last May, as sort of a follow-on, there was the $500 million commitment from Bloomberg Philanthropies, of which Sierra Club Beyond Coal campaign is a big part of that. So, a great example of how that early stage proof of concept can really sort of then scale impact later down the line. And so that's my last slide. I think the last thing I'll do, though, is back up a little bit. Whoops, back up. And take it to this slide, just because this is, I think, kind of, for all intents and purposes, I feel like this is kind of the core of what this space is all about, and trying to think about how you move from right to left. Oh, and just a couple other comments before I open it up to questions. One of the things I am learning, as I mentioned, in philanthropy is I'm starting to feel like that philanthropy bucket really needs to be sort of broken down as well, and thought through about how the players in philanthropy are coordinating in order to scale early stage ideas, so that then when you do get more people leaning into that intersection with impact investing, that that's not also a sort of bottleneck in developing those opportunities. And that's actually kind of what this research project is about, taking examples like the Sierra Club Beyond Coal campaign. Another one that's that I've heard about historically that's been fascinating is all these 40 organizations, 40 foundations that we coordinate with, realized that in aggregate that for part of the work on transforming to clean energy, that they were only spending as a group only $200,000 total for all of Southeast Asia, right? So, I mean, might as well, there was basically nothing going to Southeast Asia, which was critical geography for addressing particularly coal-generated electricity. And so as we had the conversation, sort of realized it, a few years later, there's now $9 million going towards particularly addressing coal issues in that area. And so, that's to me was just sort of another wake-up call that there's not that level of coordination that should be happening in philanthropy. And so that research project that I proposed is sort of taking examples of those case studies and thinking about what's that language and set of criteria that philanthropy maybe should be organizing around, so that we can unlock and coordinate the right types of philanthropy to move early stage organizations to fruition and to scale. So that's one thing I wanted to mention, and there was something else too. Oh, I know what it was. The other thing that I pointed out to National Geographic about sort of their opportunity for leadership in this space is the term venture philanthropy, I think, is at best is a very dated term, and also doesn't really, I think, really convey sort of the range of roles that venture philanthropy plays, as I showed on that other slide. And so for them, one of the things I put out to them was that a really good leadership opportunity for them would be to come up with what is that right term, so that it's, because, kind of, to some extent, it's a sort of a branding marketing challenge. I mean, that's what impact investing did well, is they found a good brand, a good name, and people really were inspired about it and wanted to be part of that movement. And so I think to sort of elevate the role of this, the need for this type of philanthropy, finding a better name would probably be part of how we get there. And one thing that we've been playing around with is catalytic philanthropy, which I don't know, I'm still sort of ambivalent about that one, because who doesn't want to be a catalytic philanthropist? So then it could just become too big a term where, but maybe that's the point, I don't know. Anyway, so let me pause here and open it up to questions. Yes, back there. And if you could say your name and just tell me what school you're at too, I'd appreciate that.
My name is Michaela. I'm a third-year joint degree with forestry and movement.
Great.
My question is, when you're working with some of these earlier stage ventures and you're relaxing the requirements around financial returns, what are other ways in which you look for organizations to show progress? Other metrics you use?
Yeah, it's a great
Metrics
question.
or just like indicators, rather?
Yeah, no, it's a great question. And so let me first sort of just mention that's a big part of what GIN does also is I think it's called IRIS. Neil, you probably are more up to date on this than I am, right? And so that their IRIS impact metrics is an important, so impact metrics, critical, right? Like, so if you're saying, okay, I'm gonna forego financial return, you darn well be able to show impact return, right? And so critical. And IRIS has been a leader in thinking about this. One of the things that I'll just point out, and again, this is sort of staying true to sort of the venture philanthropy role, is it's a journey. And it was a journey for microfinance too, like coming up with what are those right metrics when you don't yet have the financial returns to show is not easy and is something that, again, is really a really good role for venture philanthropy to help think about what are those metrics and helping to define them. So I remember, again, with Root Capital, in the early days, the types of things that we would point to was how many farming families we had financed, how many farming families we were sort of essentially supporting through the cooperatives that we financed. And so that was, it got to be a pretty impressive number. It doesn't tell you much about impact. It tells you, there's this whole terminology in philanthropy about output versus outcome. So, you made a loan, the loan was repaid, so those are outputs. Those are easy things to track, but it doesn't tell you have you really moved the needle on the impact, which is you want to provide sort of economic empowerment for these families. You want to mainstream them into sort of the financial system. And those were trickier. And at first we were primarily telling stories, to tell you the truth, because there wasn't an easy way to kind of roll up those metrics and say, we have provided economic empowerment for any X number of families, right? Like, how do you create a credible stat about that? But then over time, you start with the stories, and especially, and again, this is a great place for philanthropy because anyone who would hear our stories would be like, oh, clearly there's impact. Clearly you're providing economic empowerment. And then it would be part of a conversation with those philanthropists often about, okay, you get it. You know intuitively that we're driving this impact. How do we think about converting this into something that can scale? Because again, if we want to get to that dark blue bubble, it's got to be something that's rolled up and meaningful. And that is a big challenge. Absolutely. Great question. Thank you for asking that. Yes, in the back.
Oh, never mind. I'll yell, I guess.
Project, yes.
Erica, third-year joint degree.
And I'll repeat the question.
You mentioned the sort of unfortunate cyclical herd mentality of philanthropy. At the same time, you mentioned how important it is that you have people sort of end up like flocking to you to like unlock these bigger gifts and grants. Like, how do you, in your relationships with your funders and people who give you money, how do you sort of splice those two effects? And like, you want the positive press, you want the positive attraction to your what you're doing, but you don't want them to then turn away from you when the next big thing comes along. Like, how do you maintain those two?
I'm not sure I understood the question. So how do we balance the the philanthropists wanting to flock to us?
Yeah, like the balancing the herd mentality of givers with your need to also capitalize on your trendiness and like getting bigger and bigger investments a lot.
Yeah. Yeah, I don't know. Yeah, so like if they're all interested in impact investing, how do I also at the same time mobilize them for doing philanthropy? Oh, that's a good question. It's a really good question. I don't necessarily have an answer for it. Well, so first of all, I'm in the fortunate place that I'm no longer trying to fundraise from someone, right? I'm now the philanthropist, or representing a philanthropist, and no longer have to try to sing for my supper and balance that. So one of the things that I think part of the thing is, at least of being on the philanthropy side, is sort of elevating this issue. So now that I'm where I am, I can elevate this and help sort of guide funders to the importance of philanthropy. The other thing is, and I say this from, I was at the Global Impact Investing Network conference last year, and frankly, it was the first time I ever attended it. It just didn't work out for my schedule before. And I was surprised about not only how little conversation there was about the role of philanthropy in unlocking impact investing, but how de minimis any of the specific examples were. And they frankly hadn't evolved at all since the time I had been at Root Capital, which was guarantee facilities and first loss positions. That is where the conversation was still stuck, that's the role of philanthropy. So it's kind of disappointing too. And I think maybe part of the answer to your question is expanding that universe about what are catalytic roles for philanthropy beyond those things, so that people really feel like they're really moving the needle when they're making a philanthropic gift alongside their impact investing focus. So for example, and this is something that Growall did recently, and actually it's with another, I think he might be even a joint degree alum, Adam Wolfenson, who is one of the principals of Encourage Capital. So we provided a $100,000 grant to Encourage Capital to develop essentially to develop their business plan for a solar fund for small to medium-sized businesses in India. And because according to them, access to capital for doing those types of solar investments to get their energy as small to medium-sized businesses from solar was a barrier. And so we provided the $100,000 grant to Encourage. Encourage is a for-profit based out of New York. And using that and developing their business plan, they have just been able to raise $40 million for a fund to do that. So what a cool story, right? Like, there's a really interesting way to mobilize some philanthropy and unlock more capital. That's not just about first loss positions and guarantee facilities. So I think that's part of the answer to your question. And I really don't know otherwise. I think it's sort of education, sort of pointing out what I was saying, that, just like in the for-profit world, it's not like we rely on just one type of capital provider in order to create a productive financial system. So why would it be any different in philanthropy? Thanks for the question. On this side of the room, I haven't given you guys any love. Yes?
Hi, my name is Rachel Gasana. I am in the EMBA program, and I've worked my entire career in nonprofit and business development. So
Great.
It's great. I'm hoping you can say a little bit about vertical integration in the philanthropy space, as we were talking about the split up, and particularly this idea of supporting nonprofit startups on their business model and on how they're going to scale. I like that you mentioned Bloomberg, because I know they've a lot of the initiatives that they fund are wholly owned subsidiaries in many ways of Bloomberg Foundation, and also I know Siegel Family Foundation, Impact Incubators for small business and new nonprofits led by African entrepreneurs, for the most part, have done a great job, and they've really kind of taken on in-house some of that implementation. They're funding full teams that are thinking through a lot of these questions in a really meaningful, long-term way. So would love your thoughts on sort of whether you feel like this is a direction philanthropy could potentially do more and what some pitfalls might be of that.
Totally, yeah. So it became so trite. We said it so often at Root Capital, it became trite. You can't divorce capacity from capital. We found that very quickly, like in the work that we did in Root Capital, when we were going to do a loan, it's not like we could just give the organization a loan application, say, fill it out and send it in to us. We had to sit down and work through with them, how do you put together a balance sheet, an income statement, a cash flow, let alone like use of funds, how do you think about that? And what's that return gonna look like? So we discovered very quickly, and it's a kind of, I know it sounds kind of obvious, but when you're in the midst of it, you don't sort of realize these things. Really quickly that like embedded in our costs was this sort of capacity building that was taking place as we were working through loans. So we did eventually spin off a whole, I can't even remember what it's called now because we went through so many different iterations, but it was some sort of financial education program that we developed. And very clear about the fact that like there was going to be no financial return from this. This had to be funded by philanthropy. And so this is exactly what I mean about like that sort of ecosystem. These are the ecosystem of players that have to be around not only impact investing, but in philanthropy also, because that's essentially what you have in the more developed part of the space. You have that full ecosystem, and that's why the market's not as broken, because you have all sorts of, whether it's technical assistance, whether it's an economy that's advanced enough that they're able to send people to business school and hire MBAs to help them develop their startup companies, right? And you don't necessarily have that, especially in some of the emerging economies places. So part of making that a functioning marketplace is definitely investing in things like that. And so whether it's becomes part of the NGO, it could be a standalone that's part of the ecosystem, like TechnoServe is an organization that Root Capital collaborated a great deal with and has been very important to not only the small scale ag space, but a whole range of spaces around the world and providing that type of technical assistance. That's an important part of development. And or from the philanthropy itself. So at Echoing Green Foundation, they do a terrific job on that whole organizational development type of work as well. And so, yeah, it absolutely has to be there. I'm sort of ambivalent about where it lives. I think different models can work depending on what the asset class is that you're working on. But yeah, if it's not there, big problem. Definitely. Yes.
Hi, my name is Jillian. I'm a first-year SOS student. I used to work at the Packard Foundation.
Oh, nice.
San Francisco Bay.
Nice.
We had a small program-related investment arm, which was essentially our way of doing impact investing.
Yes.
In ventures that
Root Capital benefited from it.
Right, but if you work for Packard, right, it's a pretty big family foundation that's pretty change averse. We have a lot of institutional inertia around how we operate. We're tied to a family brand that has a very specific model for how they want to make change in the world. And we practice strategic philanthropy, which is not necessarily the same as opportunistic or responsive grant making that I think is really key to venture philanthropy. So how do you directly overcome those kinds of challenges that are pretty common in big traditional modes of philanthropy to then practice venture philanthropy?
I welcome your thoughts on that. I've never worked at the big philanthropy, so I don't know. But yes, absolutely, institutional inertia is a big problem. I can tell you just, I guess maybe it's a little bit of a ray of hope, if you will, is this network of philanthropists that we help coordinate. I've been pleasantly surprised how well it works. And part of the reason I think it works so well is it's like you won't find mention of it anywhere on any website or anything. It's not a formal membership. But what it does do is it creates a convening for organizations, for different foundations. And we have the range, if you will, everything from very small and just beginning to large established. And And so that, by virtue of having these direct conversations, not having to be sort of public about it, being able to sort of, that conversation that led to this aha moment about that only $200,000 going to Southeast Asia across a very large number of organizations. You can have that type of conversation and not feel like anyone's going to publicly criticize you for having not done that, and conversely, like, change it. So that's one thing that I've seen, but I would welcome thoughts, especially if anyone else has experience in sort of the large institutional philanthropies. I do think that's a fairly large barrier, because they do have all their sort of layers of bureaucracy, if you will, that can make it challenging to navigate and to have them mobilize resources in a more, I shouldn't say efficient, but more flexible way. I'd also say, to some extent, it's not necessarily, we're not necessarily, or I'm not necessarily looking for them to sort of change that. It's more them being willing to sort of stay loyal to where, being clear about where they do play in the space and staying loyal to it. You know, so it's kind of like that comment I mentioned about Rockefeller Foundation. I was pretty startled that they were so sheepish about the fact that they were playing the that they had this negative perspective on the role they had played, right? They were doing if not them, who, right? Like, and so that's the sort of thing that actually is very possible, if you will, for these large established foundations, is playing that, you know, once organizations get to that more sort of de-risked space and are looking for that size and type of capital, that seems like it's a better fit for those larger, well-established organizations. And so if there's some way that we can sort of elevate how important their role is in the landscape. Another comment on this is, I was speaking to the head of a fairly large climate philanthropy recently, and his comment was, you know, everyone likes to think of themselves as being the sort of strategic startup philanthropists. Like, they discovered the organization. And very few are willing to sort of claim that they're about, like, scaling something that's already established. This was just his commentary. And so if that's true, the marketplace might be even more broken than I realized, right? Like, if everyone's trying to pretend that they're playing the role that someone like a Growald or an Echoing Green is playing, that's concerning. Because they really shouldn't be playing in the spaces that we and Echoing Green are playing. They traditionally have been at a different place. And so helping them recognize that there's so much value in playing in that place. Otherwise, the organizations that we help seed that have potential to scale, where are they going to go if those larger organizations aren't willing to play that role? Yes.
Just kind of follow on, but maybe you weren't able to change the hearts and minds of an institutional player, but it sounds like with Nat Geo, you changed the hearts and minds of people who wanted impact investing and turned them on to venture philanthropy. Mm-hmm. And I'm wondering if you could speak more to how that conversation went. You mentioned they were like, yeah, we may not have the expertise to actually compete and do well and get any kind of return. Was there key care about that we want to make impact, and the shiny, you know, potential return was not a big factor? And in the year that you worked there, what makes them nervous?
Let me see, what can I say about, well, so I have to say, to begin with, I mean, and this is part of the reason that I took this leap of faith, was Jonathan, their chief scientist, and I were sort of very, very much on that same page about impact already. And that was why he'd written it into the strategic plan. And he was really clear this was about philanthropy and wasn't about impact investing. And I think he just didn't have enough of the terminology, essentially, to describe what it meant to be an impact investing effort from your philanthropic portfolio. And so I think it was less about that he, in particular, thought that this was about sort of traditional impact investing, and that it really was about impact first, but more about like what's the right terminology and how do you frame it up. So I think it was, frankly, it was probably largely a terminology piece. The other thing that was fascinating as I got to know the organization, and it's like most organizations, this was true for EDF as well, that are, and we're not even anywhere, EDF's not anywhere near as large as Nat Geo. There was already so much of this activity actually that was going on within the organization, but they just didn't, they knew it was happening. They didn't recognize it as what it was that they wanted to do here. And so part of what I was, what I helped them identify, so they had asked me, for example, that they wanted to do a pilot for this first effort. And as I talked to everyone, I said, well, you know what? You actually already not only have a pilot, but it's like you have the business plan for the pilot, and it's about to launch in about 2 months. And so you don't even need to deploy any more resources to have your pilot. It's already up and running, or it's already developed and is about to be launched. Call it, just call it your pilot. and these are the types of things you want to learn from that pilot. So it was more, and maybe this is a good sort of takeaway for people, especially that are in School of Management and that sort of like organizational structure thing. It ended up being both not only a terminology piece, but also sort of an organizational structure piece and sort of recognizing what your assets were. And obviously they're huge at National Geographic, but they're also pretty unique in terms of the diversity of things that was going on. The other thing, and this actually was, I was bothering Neil a lot during that time. The other thing that Nat Geo is legendary for, of course, is their media side and their sort of ability to tell stories and sort of capture hearts and minds and appeal to like a much broader audience. Like anyone I told I was working for Nat Geo, everyone would like have everyone would always have some sort of warm and fuzzy story about Nat Geo. It didn't matter who you were, what age you were, everyone without question had a story. And so they really wanted to sort of lean into that story piece because that's something they could uniquely bring. And so this is where I was bothering Neil, is like a lot of the Echoing Green grantees, Climate Fellow grantees that Neil oversees, were sort of examples of those great stories that that they were looking for in this space. And so I kept on, I think you remember this, I kept on like emailing, I was like, okay, I'm calling, I need this and this and this about your grantees so that I can create this slide for them. And so that was the other thing too, is like thinking about how to use that asset. And what were the stories essentially that they were missing, that once they had this lens, they'd be able to elevate and sort of see more impact come from it. Does that answer your question?
Yeah. One follow-up question.
Sure.
Were they as flexible about the assets they were willing to deploy? For example, was it, hey, we have cash, we just want to get it out there, please do it? Or if you came back and said, we actually need a bunch of your for-profit oriented videographers to come in because that's where we can truly make impact.
Yes.
Was that as fluid?
Yeah, they were open to that. So if you want to learn a little bit more about kind of how it evolved, if you Google Nat Geo and their innovation challenge, I believe the first one was a plastics innovation challenge. And so the innovation challenge is kind of where they're funneling all this effort through. And so it's about not only identifying entrepreneurs, but also their stories. And they showcase it at what they call their Explorers Festival every June. And so that's like this big multimedia sort of stage opportunity where they pull together all their different, essentially all of their different grantees that are under this title of Explorer. And so, yeah, they really sort of think about what's that sort of broader stage and integration of resources they can come to bring to bear beyond their direct grants. Because their direct grants, frankly, are on the smaller side. It's really what else they can provide that's going to really help supercharge things.
We have to close it
Oh, we do?
there.
Okay.
We'll have to get to class. Namrita, thank you very much for your time, for coming in today. Namrita will be an executive fellow. She's in the process of making that happen over the course of this year. The next time she'll be on campus is Friday, September 20th. We're going to open up some coffee chats with her. So if you want to have follow-up questions, you want to have more conversations, there'll be a chance for that. We'll send those out to everyone who's registered for this event. Thank you all for being here. Thank you again, Namrita.
Thank you all.